Hey everybody, Jeffrey Beamer here with your Pro Trader tip of the day. We're going to take a look at Oracle. This is trade ID 1081 from our service Delta Neutral Income, that's DNI. This is a trade that we were in for just 2 weeks and it gave some absolutely fabulous results. We just took this trade off today and the strategy was a calendar spread. So let me break it down for you. When we looked at the stock, okay, I'll pull up the entry that we sent out to our subscribers. All right, I want you to look at the chart on the left-hand side here, and you'll notice that after an earnings event back in March, the stock rallied and then it began to sell off. My analysis was that we would fill this gap, okay, this gap in price. And the question is, okay, you think the stock is going to drop, you think the stock is going to go down, what's the best strategy to do so? Now, this is equivalent to having tools in the toolbox, okay? So when you first learn options, you might think of a long put. Okay, very reasonable assumption, right? And then you learn how to reduce the cost of your put by doing maybe a spread. Okay, that's buying one option and selling another. Okay, and then as you advance through your education, there's a variety of strategies that are considered delta neutral, but they do have a directional bias to them. And you can do a combination of these. There's like a butterfly, for example. You can put a butterfly out of the money. In this case, I chose a calendar spread. That's the strategy that you're looking at here. If you look over on the right-hand side of the graph, you'll see the curved lines going into a point. That indicates that there is a time difference. So instead of right angles, we have these curves. And as you look at modeling software, anytime you see curved lines, then there's a time element to it. And the time element here is we went out to May 17th and we bought the 115 strike puts, and we helped finance that put by selling the May 3rd 115 strike puts. All right. So we took in, well, for that 117, excuse me, for that May 17th 115 put, that cost us $1.12. But I was able to reduce my debit significantly by selling the May 3rd expiration 115 put and brought that debit down to 49 cents. So instead of $1.12 for just buying a put, I brought that down to 49 cents. And the point of this is right above, okay, well, it's at 115, which is where our strikes are. So I want that to be where the stock is or as close to that point by expiration. And you'll notice that I placed it down here because that accomplishes my goal of the stock filling the gap. All right. So the stock filling the gap on this was one of the most cost effective trades to get into. We did this trade 5 times, meaning 5 spreads. My entry debit total was $2.45 with the max potential return of $8.38. Okay, and you can see that here under max profit, 838.48. Okay, that would be if we just went to 115 at expiration, meaning May 3rd, 2 days from now, and it was right at 115. And that, sometimes that happens, but not all the time. All right, so we entered the trade back on May 3rd. Or excuse me, we entered that on May 1st. We entered that trade, and that May 1st is today. My apologies. April 17th, we entered this trade. April 17th. All right. We took the trade off today on May 1st at a credit of $1.11 per spread. Since we did that 5 times, that's $555. Let's see what happened with Oracle. All right. So as we were anticipating, the stock did drop and it did fill that gap. It did bounce around here a little bit, and notice here we were trading when we took this off at 114.09. Now remember, we had the 115 put, so we're in the money by $1, which definitely helps our long put, but it also puts our short put $1 in the money. But because of the collapse in premium on that short option, as far as extrinsic value and the intrinsic value of the long put at here we are 2 days away from expiration, and our profit was $310. That is a 126.5% return on average. So when you put this together, in summary, the stock was Oracle. We put this trade on April 17th. We took it off today, May 1st. We did 5 contracts of the 115 strike put calendar spread. We bought the 17th of May options. We sold the May 3rd options, and we ended up with a $310 profit, and that's 126% return in just 2 weeks. So in summary, if you look at that 310 number, now this trade was on a hypothetical $10,000 trading account. So if you put it in that perspective, the debit of $2.45, well, that's 2.45% on portfolio. All right. And then we took our profit off at 555, okay, and subtract out the difference, and you come up with 310. That is our profit. That's a 3.1% return on portfolio in just 2 weeks. So if that sounds like a great opportunity, just keep this strategy in mind whenever you're thinking a stock might move up and down. A calendar spread might be a good way to capture big profits in a short period of time. That's your Pro Trader tip for today. Hope you have a great trading week. We'll talk to you next week. Take care.